You want to know why most people fail at investing? It's not because they're stupid. It's not because they lack information. Hell, we've got more information available today than at any point in human history. You can pull up financial statements, analyst reports, market data, all of it in about 3 seconds on your phone. No, people fail because they confuse price with value. They see something cheap and they buy it. They see something expensive and they avoid it. They're shopping for investments the same way they shop for groceries, looking for the discount sticker, trying to save a few bucks. And that mentality, that fundamental misunderstanding of what you're actually trying to accomplish is why they end up broke while other people build generational wealth. And before we're done here, I'm going to tell you about a massive distortion happening right now where entire sectors are being priced like garbage when the underlying value is extraordinary. But first you need to understand why price means almost nothing and value means everything. Let me start with something basic that somehow everyone forgets. Price is what you pay, value is what you get. When you buy a stock for $50 a share, that's the price. The value is what the business is actually worth based on its cash flows, its assets, its competitive position, its growth prospects, all of it. Sometimes the price and the value are close to each other. Most of the time they're not. Your job as an investor isn't to find cheap things. Your job is to find things where the value significantly exceeds the price. That gap, that delta between price and value, that's where you make money. Everything else is just noise. Here's a perfect example. Back in 2008, during the financial crisis, real estate prices collapsed. I mean, truly collapsed. Office buildings that were trading at $300 a square foot were suddenly available for $150. Everyone looked at that and said, real estate is cheap. But cheap relative to what? Relative to the peak? Who cares about the peak? The peak was a bubble driven by idiotic lending standards and irrational exuberance. The question wasn't whether real estate was cheap compared to 2007. The question was whether the value of the cash flows those buildings could generate over the next 20 years justified the price you had to pay in 2009. And in a lot of cases, the answer was no. Why? Because demand had evaporated, vacancy rates were spiking, rents were falling. The value of those buildings, measured by their ability to generate free cash flow, was actually lower than the price, even at a 50% discount from peak. But here's where it gets interesting. There were certain properties in certain markets with certain characteristics where the value was enormous, even though the price had also fallen. Trophy buildings in gateway cities with credit tenants on long-term leases. Those buildings were still going to generate cash flow. The tenants weren't going anywhere. The locations were irreplaceable. The replacement cost, if you wanted to build something comparable, was still twice what you could buy the existing building for. That's value. That's the gap you're looking for. I didn't buy everything that was cheap. I bought the specific assets where I could clearly articulate why the value exceeded the price by a wide margin. And that's why I made a fortune while other people who were just buying cheap real estate got killed. This gets to one of my core principles about investing, and it's something I learned the hard way over decades. Replacement cost matters more than almost anything else. If you can build something new for less than you can buy it existing, the existing thing is overpriced, period. End of discussion. I don't care what the seller tells you about growth prospects or strategic value or any other MBA horse shit. If replacement cost is lower than market price, you're paying too much. But the reverse is also true, and this is where the real money is made. If you can buy something existing for significantly less than it would cost to replace it, and there are barriers to entry that prevent someone from easily building a competitor, you found value. You found a moat. You found something that can generate returns for a long time because the economics of the market protect you. Let me give you a specific example. Industrial properties, warehouses, distribution centers. For years, these things traded at relatively low prices because they were seen as boring. No one wanted to own a warehouse. It wasn't sexy. But look at what was happening with e-commerce. Look at the explosion in demand for logistics space. Look at how much it would cost to build a new warehouse in an established logistics hub where you've got highway access, rail access, labor force, all the infrastructure. Now look at what you could buy existing warehouses for. The gap was enormous. You could buy for $70 a square foot something that would cost you $120 to build new, and demand was going up, not down. That's value. That's how you know you're onto something real. Compare that to what most people do. They look at the stock market and they see some tech company trading at 100 times earnings and they say it's too expensive. Then they see some retail company trading at 5 times earnings and they say it's cheap. They buy the retail company because of the price. They ignore the fact that retail is dying, that e-commerce is eating their lunch, that the business model is fundamentally broken. They bought price, not value. The value of a dying business is zero, no matter how cheap it looks on a PE ratio. Meanwhile, the tech company trading at 100 times earnings might be building a platform with network effects, with barriers to entry, with the ability to compound cash flows for decades. The value might be 10 times the current price, even though the price looks expensive. This is why I've never understood people who won't pay up for quality. They'll buy a mediocre asset at a cheap price and then spend years trying to make it work, dealing with problems, dealing with competition, dealing with all the headaches that come with owning something that's fundamentally second rate. Why? Because they saved a few bucks on the purchase price? That's insane. I'd rather pay a premium for a trophy asset that's going to generate superior cash flows with less risk and less hassle. The value of not having to worry, the value of owning something truly scarce, the value of having pricing power and competitive advantages, that's worth paying for. Let me talk about something that really separates successful investors from everyone else. The ability to see value that others don't. This isn't about being smarter or having better information. It's about having a different framework for analyzing what matters. Most people look at surface metrics. They look at revenue growth. They look at margins. They look at same-store sales or occupancy rates or whatever metric is standard in that industry. And those things matter, sure, but they're not value, they're indicators. The value is in the durability of the cash flows, the strength of the competitive position, the quality of the management, the structure of the industry, the barriers to entry, all the things that determine whether this business or property or asset can continue generating returns over a long period of time. Here's a brutal truth about markets. They're pretty efficient at pricing obvious things. If something is clearly valuable and everyone can see it, it's probably already priced accordingly. The opportunities, the real opportunities where you can buy below value, they come in 3 situations. First, when there's forced selling. Someone needs to liquidate because of redemptions or bankruptcy or divorce or death or whatever. They're selling because they have to, not because they want to. The price isn't determined by value, it's determined by their desperation. That's when you can buy below value. Second, when there's a structural change happening that the market hasn't fully recognized yet. Maybe it's demographic shifts or technological change or regulatory change or something else, but the value of the asset is going to be different in the future than what the current price reflects. If you can see that change before everyone else, you can buy at a price that doesn't reflect the future value. Third, when something is out of favor, when an entire sector or asset class has been beaten up and everyone's running for the exits. That's when you get prices that are completely disconnected from value because fear dominates. Let me tell you about my favorite kind of opportunity, the kind I've built my entire career on, buying distressed assets. When everyone's panicking and selling, that's when I'm looking to buy. Not because I'm a contrarian for the sake of being a contrarian. I'm not trying to catch falling knives just to prove I'm smarter than everyone else. I'm looking for situations where the distress is forcing prices down below the value of the underlying cash flows, where the market is pricing in Armageddon, but the actual fundamentals suggest recovery, where everyone's focused on the near-term pain and completely ignoring the long-term value. The savings and loan crisis in the late 80s, early 90s, that was perfect. Banks were failing, real estate was in the toilet, everyone thought it was the end of the world. Buildings were being sold by the RTC for 30, 40, 50 cents on the dollar. But the buildings were still there. The locations were still good. People still needed office space and apartments and retail space. The demand would come back, it always does. But in that moment, the price was determined by panic, not by value. So I bought everything I could. And I made a fortune because the value was always there, even when the price suggested otherwise. Now, let's talk about the flip side of this because it's equally important. Just because something is trading at a high price doesn't mean it's overvalued. I see people make this mistake all the time. They look at Amazon or Google or whatever and they say it's too expensive because the PE ratio is high or because the stock price has gone up a lot. That's price thinking, not value thinking. The question isn't what the stock price is. The question is what the business is worth. If the business can compound cash flows at 20% annually for the next decade because of network effects and scale and competitive moats, then maybe it's worth 100 times earnings. Maybe it's worth more. The value is in the future cash flows, not in the current price relative to historical averages. This is why I've never been a value investor in the traditional sense. I don't just buy things because they're cheap on some multiple. I buy things because I believe the value exceeds the price. And sometimes that means paying what looks like a high price for something that's actually worth even more. The best investment I ever made, equity office properties. We built that by buying quality buildings in great locations. We didn't always buy the cheapest buildings. We bought the best buildings when we could get them at a price that made sense relative to the value they would generate. And when we sold the company in 2007, we sold it for $39 billion because we'd accumulated a portfolio of irreplaceable assets that couldn't be replicated at any reasonable cost. Let me hit you with something that's going to sound contradictory but isn't. Sometimes the best value is paying zero, not buying anything, just sitting in cash or treasuries or whatever and waiting. Because if you can't find investments where the value clearly exceeds the price, the best investment is patience. I've gone years without making a major acquisition because the market was too frothy, because prices were too high relative to value, because everyone was chasing the same deals and bidding everything up beyond what made sense. And people would ask me, Sam, why aren't you investing? You're sitting on all this cash. You're missing opportunities. No, I'm not missing opportunities. I'm waiting for real opportunities, not fake opportunities created by cheap debt and momentum and fear of missing out. The irony is that by waiting, by being patient, by refusing to pay prices that exceed value, you put yourself in position to make the best investments when everyone else is tapped out. When the distress comes, and it always comes, you've got dry powder, you've got capital to deploy when prices crash below value. That's the whole game. Buy when value exceeds price, sell when price exceeds value, wait when they're roughly equal. It's not complicated, but it requires discipline that most people don't have. Now let me talk about how to actually assess value, because I realize I'm throwing this term around, but I haven't given you a practical framework. Value comes down to three things: cash flows, risks, and alternatives. First, what are the cash flows this asset will generate over its life? Not pro forma cash flows, not adjusted EBITDA, not some bullshit metric that Wall Street invented to make garbage look good. Real cash flows. Money that actually comes in that you can actually spend. Second, what are the risks to those cash flows? What could go wrong? What are the competitive threats? What are the regulatory risks? What are the market risks? How durable is this? And third, what else could you do with the money? What are your alternatives? Because value is relative. A building generating a 5% cash on cash return looks great if treasuries are at 2%. It looks terrible if treasuries are at 6%. You have to compare the value of what you're looking at to the value of your other options. This is why I'm obsessed with free cash flow. Not revenue, not gross profit, not net income, free cash flow. The actual cash that the business or property generates after all expenses, after all capital expenditures, after everything. That's what you own. That's what determines value. And when I'm looking at an investment, I want to know what's my cash on cash return based on conservative assumptions, how long until I get my money back, what's the IRR if things go reasonably well, what's the downside if things go poorly, and most importantly, what's the margin of safety between what I'm paying and what I think it's worth. Margin of safety is everything. This is Ben Graham, this is Warren Buffett, this is every successful investor who's ever lived. You don't buy something at exactly what you think it's worth. You buy it with a margin of safety so that if you're wrong, if your assumptions are off, if the world changes, you're still okay. You're still not losing money. That margin is the difference between the price you pay and the value you calculate. The wider that margin, the better the investment. And in frothy markets, that margin disappears. Everything's priced at or above value. That's when you wait. Let me give you a current example of price versus value that's going to make some people angry. Office real estate. Everyone's running away from it. Work from home, declining occupancy, rising vacancies, falling rents. The narrative is that office is dead, and because of that narrative, prices have collapsed. You can buy office buildings in some markets for a fraction of what they cost to build. So is that value? Maybe. Depends on the building. A Class B suburban office building with short-term leases and no amenities, that's probably worth zero. The demand is never coming back. But a trophy building in a gateway city, well located, great amenities, long-term credit tenants, that might be extraordinarily valuable at today's prices. Why? Because not everyone's going to work from home forever, because the best companies are going to want the best space to attract the best talent. Because you can't build a new trophy building in Manhattan or San Francisco for anything close to what you can buy existing buildings for. The replacement cost creates a floor. The scarcity creates value. But you have to be able to separate the quality from the junk, the value from the price. And this gets to the big distortion I promised you at the beginning, the thing nobody's paying attention to because they're too busy arguing about AI and crypto and whatever else the media is hyping, energy infrastructure, pipelines, storage facilities, processing plants, all the boring stuff that moves oil and gas and natural gas liquids from where they're produced to where they're consumed. This stuff is trading at absurd discounts because ESG investors won't touch it, because the narrative is that fossil fuels are dying, because everyone wants to virtue signal about climate change. But here's the reality. The world uses 100 million barrels of oil a day. That's not going away anytime soon. Natural gas is the only viable way to back up intermittent renewables. And the infrastructure to move and process these commodities is absolutely essential and cannot be replaced quickly or cheaply. These assets generate enormous free cash flow. They have long-term contracts with creditworthy counterparties. They have inflation protection built into the fee structures. They have barriers to entry because you can't just build a new pipeline overnight. The replacement cost is astronomical. The regulatory approvals are nearly impossible to get, and they're trading at 6, 7, 8% yields while everything else is trading at 3 or 4. Why? Because of narrative, because of ESG, because everyone's decided that these assets are dinosaurs. That's the opportunity. That's where price has divorced from value so dramatically that the returns are going to be extraordinary for anyone willing to look past the narrative and focus on the cash flows. This is what I mean when I say never buy for price, buy for value. The price of these energy infrastructure assets is low, but the value measured by their cash flows and their competitive position and their replacement cost is high, really high. And when the market eventually figures this out, when the narrative shifts, when people realize that we need this infrastructure, regardless of what they think about fossil fuels, the price is going to adjust to reflect the value. And the people who bought based on value instead of price are going to make a fortune. Here's what you need to do. Stop looking at what things cost and start looking at what they're worth. Stop comparing prices to other prices and start comparing prices to cash flows. Stop following the crowd into whatever's expensive because it's going up, and start finding things that are cheap because they're misunderstood or out of favor, but fundamentally valuable. Develop your own framework for assessing value based on durability of cash flows, barriers to entry, competitive position, all the real things that matter, and have the discipline to wait when nothing's trading below value and the courage to buy when everything's on sale because of panic. Value investing isn't about buying cheap things. It's about buying things where the value exceeds the price. Sometimes that means paying up for quality. Sometimes that means buying distressed assets. Sometimes that means doing nothing and waiting. But it always means understanding the difference between what you're paying and what you're getting. Price is temporary. Value is enduring. Focus on the value, and the price will take care of itself. If you want to learn how to think about value instead of price, how to find opportunities that everyone else is missing because they're focused on the wrong things, hit that subscribe button and like this video. And if you've got questions about specific investments or sectors or how to apply this thinking to your situation, drop them in the comments. I'll give you straight answers based on fundamentals, not on whatever the narrative of the day happens to be. Because understanding value is the only way to build real wealth. Everything else is just speculation.